Hello, everyone. Welcome to episode 21 of the Inevitable Wealth Podcast. I'm Jacky P, and I'm with
Julian Leonardo.
Yep. And today we're talking about preparing for 2026 and what actually matters financially for you and your goals. So, as we look ahead to 2026, right, we want to talk about some predictions, but not predictions that most folks are used to, like market forecasters, but really how to position yourself in your finances so you're flexible and able to really manage how the next year that's coming unfold. So a few areas stand out, and we'll try to keep this concise, but Julian, take us away.
4 to 5 ideas. First, my expectation, taxes stay front and center, right? Whether rates ultimately rise or fall or stay the same, uncertainty itself is not the issue. Planning matters much more than guessing. So as you evaluate your situation, your role, your job, income timing, Roth strategies, capital gains planning, and understanding where future flexibility exists will matter much more than reactive tax or investment moves.
Yeah.
So the people who benefit most aren't the ones trying to outsmart the system. They're the ones creating options for themselves going forward. Anything to add there?
Yeah, I mean, I always say this, even when I speak to like high school kids, college kids, the tax man cometh, right? So
they always get their piece.
Yeah, they're always gonna get their piece. So playing around that, we always like to say, we believe in paying our taxes, but we don't believe in giving the government a tip, right? So making sure you're on top of your tax planning strategy, because tax planning is a full year thing, not just the end of the year.
Exactly. And February, March tends to be bonus season, RSU season, stock option season. You want to evaluate how that impacts your situation. Make sure you're, of course, paying as minimal as possible, but it all aligns with your plan overall.
Yep, great. Second, estate planning, right? It's becoming less optional. And this isn't just really about the wealth transfer. It's about the control and the clarity, reducing friction of the people around you. Documents that haven't been reviewed in years, whether it be your will, power of attorney, living will, make sure that they're addressed with the common laws and things that have changed over time. It's important, right? Because it will definitely impact family dynamics. It'll impact what taxes might be paid by your state. And it should just include reviewing that. This is something that is, I think, very vital. And unfortunately, a lot of people don't do.
Nobody wants to think about it.
Yeah.
It can be tough. I mean, one of the more challenging parts of our role is we work with so many great families that I consider friends, and people do pass away. And if they don't have updated documents, if they don't have updated beneficiaries, power of attorneys, how assets are titled, they need to prior to that. Because no matter what happens, you want to make it as seamless as possible for your family. Even if things go smoothly and you have a will, probate does take quite some time, right? So if you can avoid probate, if you can give your family that were to inherit your entire life savings more options in how they reduce taxes on the piece they do receive, that's a no-brainer. And nobody wants to pay more taxes because they weren't prepared or have it go to the wrong person because they weren't paying attention or just didn't want to think about it.
Yeah. And I know I've said this probably multiple times before about always say we're talking about estate planning. Beneficiaries and TOD, which stands for transfer on death, that supersedes your will. I was speaking with a new client just 2 weeks ago. She was mentioning a family friend got married, started at a company, had his wife as the beneficiary. They divorced. He got remarried. 20 years later, he passed, never updated beneficiary. So all those funds went to his ex-wife, right? So make sure that aligns and review it regularly, because it's written in law, right? Like if he's designated beneficiary, it's really hard to contend.
Exactly. And that's why with that, if you have old 401ks, a lot of folks forget about them. It's often best to consolidate, right? Because you forget about it. It's been 15 years. You've had it since 2000. You want to make sure that everything is up to date as far as estate planning right? And those beneficiaries are extremely, extremely important because the government has a plan for you, right? Your given state has a plan around the estate if you were to pass. So you might as well have a say in it and be able to dictate where it goes and how it gets there optimally.
Yep. And also, again, in case I'm not here folder, if especially if you're, like most families, like it's someone who's usually really on top of the finances, really interested in it, and the other partner usually isn't. That's sometimes how we see it. And if you're the person who's on top of the finances, know where the accounts are, know where you pay your taxes, your insurance, something happens to you, you need to make sure that there is a list of where all the accounts are, who to pay, right? Your financial advisor, your accountant, all these people have it on one document so it's easier to manage. Very important. Exactly.
Passwords, et cetera, et cetera.
Yeah.
I can tackle the third. Asset allocation needs to reflect reality, not headlines. So a lot of portfolios that folks are doing themselves still reflect decisions made in a very different interest rate or inflation environment. They may be chasing returns. A good year means they're looking to get more aggressive, whereas if last year was a bad year, they're getting more conservative. You want to be market agnostic, right? Your plan is personal based on your timeline, and so it should reflect reality, not the news or what's going on today on CNBC and what Jim Cramer's saying. You want to keep it simple. You want to align it with your time horizon, cash needs, and behavior, not just the performance of the market over the last week.
Yep.
Additions, go.
Yep. I would also say invest for the true headline. We always like to ask some of our families, if something's gone in the news, in the market, which is almost every day, you got to ask yourself, is this something that's going to be impacting my portfolio a year from now, 2 years from now, 3 years from now, et cetera? So understanding that the news cycle is exactly what it is. It's a cycle. It's going to go up, up and down, left and right, you name it. And you got to put those blinders on. You just have to.
Exactly. And as a financial advisor, it's something we see a lot, where when there is a good year and things are going well, part of our job is talking to the families we serve and saying, hey, we don't need to get more aggressive just because things have been good, right? Just because there's no traffic doesn't mean we need to go faster. We can continue on the state we're in because there will be storms, there will be traffic along the way. And then when it's a bad market, recognizing that could mean opportunity, it doesn't mean we need to go to cash or go to all bonds or do anything that doesn't align with the goals and the risk tolerance of the family we're serving.
Yeah.
Right. So stay in your lane, stick to the plan. It will work out in time.
Yeah. And also, I always tell folks, please be very, very, very hesitant to make those predictive movements. Because the reactionary sometimes, although not good, more understandable, right? You're scared, you panic, you sell because the market's doing whatever. But you see a headline and you think something's coming down the pipe. And then that's that's even worse because you make these huge changes when you think something's going to happen and it doesn't come to fruition. And then now you're like trying to catch a falling knife. Like, do I wait? Do I hold on? So again, as we say all the time, block out the noise and focus on the long term.
Yep. You can tackle the fourth one.
Yes.
What are we looking at for fourth expectation?
Cash. Your cash, you worked hard for your money should be working hard as well for you, right? It needs an actual job. We see this a lot of folks, I think we see sometimes the two extremes. We see the folks who have a ton of cash. And yes, you need an emergency fund. That is your fire extinguisher. That's going to give you optionality and flexibility when those unforeseen expenses come.
Of
right?
course.
But do you need 5-6 years worth of expenses in cash? Maybe not. And then you have folks on the other end who maybe they might have 1 month of expenses or 2 months of expenses.
Yes. Making calls on the market. I'm going to put it in and then I'm going to take it out when I make a little bit of money. I'm going to put it back in and I'm going to take it out when I get a little more money. It never works, right? It might work once, it might work twice, but you keep doing it, you will get burned, right? You can't keep touching the fire. So you want to be cautious of that. And with that, when you're looking at having a high amount of cash, yes, it's more comfortable. It can make sense for a lot of families, but be conscious of inflation, right? It's going to consistently eat away at your dollars, much like Jacky touched on. And you have to keep up with the growth in the market. It doesn't mean you need to get aggressive and buy all stock, but if you hold J&J stock or Clorox stock or whatever it may be, when they raise the price of Band-Aids, you're getting a piece of that, right? You're getting a very small piece of that. When they raise the price of Gatorade, you're getting a piece of that when you hold the stock. So I'm not sure if it's Pepsi or Coke that owns Gatorade, but one of them does.
One of them does.
And so you want to stay on these things, keep growing with that, and just try and continue to keep up. Because if you don't, in time, your cash will just lose half its value, lose a third of its value, as is almost a given in the market.
Yeah. And also, when we're speaking of cash, whether it's a little bit or a lot of it, make sure it's in a high yield fund, and don't just read high yield. Because I just got a letter from the credit union I use, and it said, "Congrats, you have a high yield savings account," and it was 50 basis points, 0.5%.
Yep.
Right. So currently, where interest rates are, as we're recording this, right, somewhere in the 3 to 4% range is something that you can easily get out there without trying too hard. So make sure, if that cash is parked, it's getting something decent and not just, 0.1% or whatever some of these accounts get.
And we work with a lot of families who have a couple $100,000 in cash. So, for example, if you have $100,000 in cash and you're getting 0%, that's not ideal. If you're getting 3.7% is the rough estimate I'm seeing today, that's $3,700, right? You can do a lot with that as you look to pay for holiday gifts, tackle any debt, gift to your children, anything like that is much easier when you have more money to do it.
Yep. So let's get into, I'm going to air quote here, predictions, because we're not the predicting types, but just things to talk about as the year approaches.
Yeah, I can start off. So again, market's always going to change, but a lot of things do stay the same, and it revolves around headlines. So when you think about it, my expectation for next year is inflation pressure continues, right? And that may be in reality or in headlines, where you're going to hear these narratives around, hey, inflation's higher, inflation's lower, and you're going to see the market whipsaw a little bit. It doesn't have to be so aggressive, but that's something that is going to continue to be in the news, especially with the conversations around rate cuts, a new Fed chair, and things like that. So don't need to get too aggressive to take advantage of it, but it will be a continued narrative.
Yeah. And in that environment also, it gives the Fed flexibility. And I'm going to say this, so I tell everyone, the scatter plots that they release at the beginning of every year, no disrespect to the very smart individuals at the Fed, but ignore them, please, everyone. Ignore them, because those come out every year, and they say they're expecting X amount of rate hikes or cuts. And I don't know historically if they've ever even been anywhere near like what those predictions.
It's always changing. When you're looking 12 months out based on inflation data you don't have and jobs data you don't have, it's very hard to say, are we going to cut next December? We all like to, but also when you're cutting, it means there's market weakness. So there's a lot of components to it, but you can't quite say what's going to happen next December.
Yeah.
What's the weather going to be like next December? We don't know.
Yeah. We don't know what the weather's going to be like next week. So, so like when those come out, for the few folks that do follow that, just ignore it. I'd say just ignore it.
And then I would add, my expectation may change, is market leadership likely to broaden. It doesn't mean that the Magnificent Seven doesn't continue, but when you look at valuations, the less magnificent 493 are doing much better if you were to buy them today from a valuation perspective. So they're not doing much better, but they are much better values based on their price to earnings ratio. And then you also have international stocks, which have had a tremendous year. We've been lucky to hold them for all the families we serve, where they're up about 27%. And even with that, their valuations still are much, much more ideal than a lot of these Mag 7 stocks.
Yeah.
So, it's something where the families we serve are very diversified. But if you're someone making trades yourself and you're looking at NVIDIA or GE Aerospace is at a great year,
Yeah.
these different companies that are a little bit top heavy and their price to earnings is well over 30, well over 50, you want to be logical in what your next step is.
Yeah. And I think that's a good point as well, that as we are seeing things broaden, but also just a great reminder to not get too much into the, hey, again, NVIDIA is doing great, tech stocks are great, I want to pour more money into that sector just because they're doing great, right? You always want to make sure you have a fair and balanced approach, because also historically, and this is not a market prediction, this is just more of a history lesson, the second year of a presidency typically tends to start off more rockier. Not necessarily saying it's going to be a bad year, but just looking back, as long as they keep tracking. So that is something that we always encourage folks is like, don't let the wins of today and this year really inform your moves next year.
Exactly. Your plan should be personal. Your investments should be diversified. Just because something's doing well doesn't mean you need to double down. Take the win. Be happy with where you're at. Continue to grow from there. So, Jacky, you can take us away with the closing, unless you have anything else to add.
No, nothing to add. Just really the best preparation for 2026 isn't a forecast, isn't a prediction, right? It's just having clarity around what your tax situations would look like, structure around your estate planning, around your assets, making sure your state documents are updated. If I can give you all a 2026 resolution challenge, make sure your estate plan documents are up to date, and also an allocation that matches yourself, your financial goals, and your time horizon, not someone else's.
Not Jim Cramer.
Not Jim Cramer,
Not the headline of what Jim Cramer has going on today.
Yeah.
If you don't know who he is, great. You're doing much better than most folks.
Yeah, because we're always, and we hear this all the time, we're always in uncertain times, just because no one has a crystal ball. But being ready and having a plan is the best way to be in a position to win.
Yep.
So,
well, thanks everybody for joining us. Jacky, Julian, have a great week.
Take care.